If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. What drives a small Central European economy to hit record output, even as global uncertainty looms? How does the Czech Republic's productive machine keep humming in 2025, pushing past headwinds and setting new benchmarks? Let's break down the Czech Republic's economic engine as it powers through 2024 and 2025. 5 key pain points have shaped the landscape for investors. First, the challenge of sustaining GDP growth amid regional slowdowns. Second, the pressure of keeping unemployment low and labor markets tight. Third, navigating monetary policy as interest rates gradually ease. Fourth, maintaining inflation within target while cost pressures persist. Fifth, ensuring public debt remains manageable without stifling investment. By the end of the second quarter of 2025, the Czech Republic's GDP annual growth rate stood at 2.4%, matching the previous quarter. In 2024, real GDP growth averaged about 1.1%, a notable acceleration from the sluggish pace of 2023. Projections now anticipate nearly 1.9% full-year growth in 2025, with around 2.1% expected in 2026. This signals a stabilizing recovery path. Unemployment remains low and stable. In June 2025, the jobless rate held at 4.2%, unchanged from the previous month and near the lowest level since late 2024. Long-term unemployment stayed steady at roughly 0.7%, showing limited job displacement over time. Monetary easing has been cautious. The benchmark interest rate dropped to 3.5% in May 2025 after a 25 basis point cut. This concluded a multi-step reduction from over 4%, with the central bank signaling limited further moves unless inflation falls further. Inflation has moderated but remains slightly above target. Headline consumer price inflation eased from over 2.8% in January to around 2.4% by May 2025, still within but near the upper limit of the central bank's tolerance band. Core inflation in June was about 2.96%, while harmonized European Union inflation stood near 2.8%. Public debt is stable. In 2024, the public debt to GDP ratio was 43.6%. Preliminary data for the first quarter of 2025 shows a similar figure of 43.4%, confirming steady debt trends. The general government deficit was approximately 3.7% of GDP in the first quarter, indicating manageable fiscal pressure. Here's a snapshot of key macro indicators. GDP growth averaged 1.1% in 2024, with a 2.4% annual rate in the second quarter of 2025, and forecasts near 1.9% for the year. Unemployment is about 4.2% overall, with long-term unemployment around 0.7%. The latest policy interest rate is 3.5%, with cuts paced by inflation signals. Headline inflation is about 2.4%, core at 2.96%, and harmonized at 2.8%. Debt to GDP remains near 43.5%, with a stable outlook through early 2025. These metrics point to a stable and productive environment, steady growth, healthy labor utilization, accommodative monetary stance, moderated inflation, and sustainable fiscal conditions. What's driving this productivity? Domestic demand remains a key growth engine. Strong household consumption, rising real wages, and resilient services spending underpin GDP growth. Private consumption, the majority of output, expanded steadily, supported by stable credit and intact consumer confidence. Investment, both public and private, has rebounded. Gross capital formation rose notably in mid-2024 and stayed elevated into the first quarter of 2025. Infrastructure projects and private sector investment in manufacturing and logistics are gradually boosting productive capacity. Exports and industrial production show resilience. Despite global trade headwinds, Czech exporters of machinery, autos, electronics, and industrial inputs have maintained strength. Investment in innovation and regional supply chains supports export-led productivity. Labor productivity is benefiting from low unemployment and tight labor markets. With joblessness at about 4.2%, competition for skilled labor has increased, fueling wage growth and firm-level productivity improvements. Long-term unemployment below 1% highlights labor market efficiency. Financial conditions remain supportive. The central bank's policy easing and stable deposit rates have improved conditions for business and household borrowing. Non-performing loan ratios are low and credit growth continues, especially for corporates and small and medium enterprises. Inflation stability supports planning and investment. With inflation within target, price expectations stay anchored. Controlled inflation reduces uncertainty around costs, encouraging long-term contracts and capital deployment. Fiscal prudence underpins resilience. With debt at roughly 43 to 44% of GDP and moderate deficits, fiscal space remains sufficient. The government retains capacity for counter-cyclical spending if needed, without risking debt sustainability. External resilience is also clear. A current account surplus driven by strong exports and service receipts supports foreign reserves and exchange rate stability, reducing macro risk from external shocks. However, challenges and productivity risks remain. External demand weakness, especially from Germany and other European Union markets, could dent export growth and investment in 2025. Inflation in services, including housing and utilities, remains sticky and may require cautious policy response. Global trade tensions and tariff uncertainty could disrupt industrial supply chains and business sentiment. The scope for further rate cuts is limited, with service inflation signaling challenges in further monetary easing without risking price stability. What policy recommendations should investors watch for to sustain productivity? Maintain gradual monetary easing tied to continued disinflation, particularly in services, before lowering nominal rates further. Incentivize private investment in innovation, technology, the digital economy, and research and development through targeted policies and public-private grants. Strengthen export diversification to cushion against regional slowdowns, including expanding non-European Union trade ties. Increase vocational and technical training to boost labor market adaptability and productivity, especially in manufacturing and services. Sustain public investment in green infrastructure, transportation, and digital connectivity to support long-term output capacity. Preserve fiscal discipline to remain capable of counter-cyclical support if global conditions worsen. Monitor drivers of services inflation and manage housing-related cost pressures to maintain price stability without choking consumption. If these strategies are implemented, Czech GDP growth may hold near 2% in 2026, unemployment could dip further toward 4%, inflation could settle near 2%, and debt to GDP may fall below 43%, supporting a stable, productive trajectory. In conclusion, the Czech Republic in 2024 and 2025 stands as a strong example of a productive economy, consistent output growth, low unemployment, moderate inflation, and stable fiscal fundamentals. The interplay of domestic demand, export resilience, and investment underpins this performance. With disciplined macro policies and targeted reforms, productivity gains can be sustained and deepened, positioning the country for continued economic vitality in a challenging external environment. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.